Welcome to Griffonomics.
Thank you so much for having me.
Today, we are looking at a company that is just quietly pulling off one of the most aggressive high-stakes pivots in the history of the tech industry.
Oh, absolutely.
Oh,
It is a phenomenal high-wire act to watch.
right. We are talking about an organization sitting on a staggering $46 billion backlog, and they are preparing to spend what effectively amounts to their entire net worth in a single calendar year.
Yeah, and doing it all with the heavy backing of the undisputed king of AI hardware, NVIDIA.
Exactly. So that is our mission for today's custom-tailored deep dive. We are generating a granular investigative report into Nebius Group.
Because they aren't just a legacy IT engineering team anymore.
No, not at all. They are fundamentally transforming into a vertically integrated AI infrastructure powerhouse. We are tearing through their financial filings, earnings calls, and analyst reports to really decode three massive developments here.
The big three.
Right. First, that jaw-dropping $46.4 billion contracted backlog. Second, their terrifyingly aggressive $20 billion capital expenditure mandate for 2026.
Which is just a staggering number.
It really is. And third, how their deep strategic alliance with NVIDIA creates this powerful early access moat that competitors simply cannot cross.
The stakes here really couldn't be higher, not just for Nebius, but for the actual physical architecture of the internet itself.
Yeah, so if you were sitting there wondering why you should care about a data center company when, your focus might be on the shiny new AI software models, well, this is your wake-up call.
Software needs an engine.
Exactly. And right now, the AI industry is slamming into a very physical, concrete, and copper bottleneck. Understanding Nebius's playbook is your shortcut to being genuinely well-informed on where the future of computing is actually going.
Couldn't agree more.
Okay, let's unpack this. Before we get blinded by the billions of dollars flying around, we really have to look at the machinery. What is Nebius actually selling?
Right, the actual product.
Yeah, and structurally, how is their tech stack diverging from traditional cloud providers like AWS or Azure?
Well, to really understand the Nebius strategy, you have to look at the physical reality of AI. Right now, a massive 94% of Nebius's revenue comes directly from their core AI cloud.
94%. So that is the entire core of the business.
Is the engine. Now, legacy providers, the big three, they are spending absolute fortunes trying to retrofit their older traditional data centers to handle modern AI workloads.
Which is a nightmare, right?
Oh, it's brutal. Because traditional cloud infrastructure was built for regular CPUs, which are relatively low power. A standard server rack might draw like 10 to 15 kilowatts of power.
Okay.
But a modern AI server rack packed with NVIDIA GPUs, that can easily draw 100 to 120 kilowatts.
Wait, that is nearly 10 times the power density in the exact same physical footprint.
Exactly. And when you draw that much power in one spot,
Yeah.
you generate an ungodly amount of heat. You can't just blow cold air on these things anymore.
Like a giant air conditioner.
Right? That doesn't work.
Yeah.
You need direct-to-chip liquid cooling. And the legacy cloud providers are finding out the hard way that you cannot just easily retrofit a building designed for air cooling to suddenly pump thousands of gallons of specialized cooling fluid through its floors.
The floors just weren't built for that kind of weight or plumbing.
Exactly.
Yeah.
But Nebius is bypassing this entirely. They are vertically integrated, building greenfield data centers from scratch.
Meaning brand new facilities constructed from dirt to ceiling.
Yes, specifically engineered for liquid-cooled AI workloads from day one. They even design their own proprietary server racks to optimize the exact flow of power and coolant.
I just want to mention, just to paint the complete picture for everyone, they do hold some non-core assets on their books, right?
Yeah, a few.
Like about 6% of their revenue comes from an edtech service called 1010, and they operate an autonomous vehicle unit called Everyday, which partnered with Uber, plus a 25% equity stake in ClickHouse.
Right, but make no mistake, the true engine of their valuation is absolutely that core AI cloud.
Okay, but the earnings calls reveal they don't just want to be the landlord of this new automated factory. They are hitting a strategic inflection point here.
They are aggressively moving away from just being a bare metal GPU rental service.
Right. So renting bare metal GPUs is like a landlord just renting you an empty kitchen. But Nebius's pivot means they want to provide the master chef, the ingredients, and the recipe book too.
That is a brilliant way to put it. They are pushing to become a full workflow provider.
Is this software layer the true secret to keeping customers sticky?
What's fascinating here is that, yes, absolutely.
Yeah.
Because if you just rent out raw compute hardware, no matter how specialized the building is, you eventually become a heavily commoditized utility.
Someone will always undercut you on price.
Exactly. So
Yeah.
to combat that, Nebius is deploying a highly sophisticated proprietary software layer. For example, their Aether 3.1 control plane.
What does that actually do for the developer?
Well, in a market where securing GPU compute time is notoriously difficult, Aether gives developers unprecedented real-time visibility into capacity. They use these things called capacity blocks.
Oh, so customers can see exactly what hardware is coming online and dynamically allocate their workloads.
You got it. And they aren't just building software. I mean, they're buying it too. They just acquired a company called Tavali, which bakes market-leading agentic search directly into the Nebius cloud environment.
And agentic search is a massive leap up the value chain. That isn't just standard web search.
No, it allows AI models to autonomously navigate the internet, verify facts, pull real-time data, and execute complex research tasks without human intervention.
So by integrating Tavali natively, Nebius isn't just giving you the hardware to run your AI, they are giving your AI the specialized tools it needs to interact with the outside world.
Exactly. Now, supporting all this compute requires an absolute ocean of electricity. They have this initiative they call the Gigawatt Roadmap.
Right. They ended 2025 with about 170 megawatts of active power.
But by the end of 2026, their target is to scale up to an astounding 800 megawatts to 1 gigawatt of connected power.
Just for context for you listening, 1 gigawatt is roughly the power capacity required to light up a mid-sized city of about 750,000 people.
It's massive.
Yeah.
And what is so interesting is how this immense physical scale pairs with their newly launched token factory.
Right, which is their platform for managed inference. Let's pause and define that because managed inference sounds like pure corporate jargon to most people.
Fair enough.
Inference is the actual moment the AI does its job, right?
Yeah.
Not the training phase where it reads the whole internet, but the moment you ask it a question and it generates an answer.
Spot on. Training requires huge interconnected clusters running for months. Inference is the day-to-day operation. But setting up the plumbing to run inference efficiently at scale is incredibly difficult.
You need DevOps teams to manage traffic and keep models from crashing.
Right. And Token Factory automates all that plumbing. Developers bring their open source models, plug them in, and Nebius handles the rest. By bundling these MLOps tools, Nebius can charge a massive premium.
And it keeps them from commoditization. Once you embed your workflow into Aether and Token Factory, switching to AWS becomes a massive, expensive headache.
Exactly. It makes the platform incredibly sticky.
But providing that automated assembly line, the specialized software, and city-scale electricity, I mean, it burns cash at a rate that is difficult to fully comprehend.
Oh, it's astronomical.
To build this out, Nebius is staring down what analysts are calling a CapEx mountain. Let's look at the financial realities from their fiscal year 2025 review because the numbers are wild.
They really are.
The hypergrowth is undeniable. Q4 2025 revenue hit $227.7 million. That is a massive 547% year-over-year increase.
And beyond just the sheer velocity of the top-line revenue, they hit a critical milestone that proves the business model is actually viable.
Profitability.
Yes. In that same fourth quarter, they achieved their first positive group-adjusted EBITDA of $15 million. And even more telling, the core AI cloud segment specifically reached a highly robust 24% margin.
Incredible. And they ended 2025 with $1.25 billion in annualized run rate revenue, or ARR. That is already a massive business.
But their guidance is what truly stops you in your tracks. They are guiding for an astronomical $7 billion to $9 billion in ARR by the end of 2026.
To jump from $1 billion to potentially $9 billion in 12 months requires a scale of physical infrastructure deployment that is basically unprecedented.
Which brings us to the CapEx Mountain. To physically build the capacity needed to hit those targets, management has established a mandate to spend between $16 billion and $20 billion on capital expenditures in a single year.
Here's where it gets really interesting. $20 billion in CapEx is nearly the size of their entire market cap. That's like taking out a mortgage equal to your entire net worth in a single year just to buy specialized ovens for that kitchen. How is the market not terrified by this leverage?
Well, the market is definitely holding its breath. But to understand how they pull it off, you have to look at how that money mechanically breaks down.
The 80-20 rule.
Right. About 80% of that massive cash outlay is earmarked purely for purchasing the actual GPUs from NVIDIA. These chips are incredibly expensive, and Nebius is buying them by the tens of thousands.
And the remaining 20%.
That goes toward the physical data center infrastructure. The concrete, the miles of fiber optic cables, massive power substations, and those complex liquid cooling systems we discussed.
Okay, but how exactly does a company fund a $20 billion build-out? You can't just put that on a corporate credit card.
No, you definitely cannot. It is an intricate, high-stakes funding mix broken down into roughly a 60-40 split.
So 60% funded internally.
Yes, through cash on hand. They ended 2025 with nearly $3.7 billion in cash. But the real secret weapon here is upfront cash prepayments from clients.
Oh, right. When customers sign these multi-year compute contracts, Nebius negotiates heavy upfront payments. They are effectively using their clients' balance sheets to fund the construction.
Precisely. It's brilliant.
It's like selling off-plan real estate. You get the buyers to fund the construction of the condo before you even pour the foundation.
That is exactly what it is. But that still leaves a 40% gap that has to be filled with external financing.
And historically, Nebius has operated with zero corporate debt, which is rare.
Very rare. But to bridge this gap, they just announced a $3.75 billion private offering of convertible senior notes. And analysts also mention asset-backed financing, basically using the GPUs themselves as collateral.
Because NVIDIA GPUs hold their value so well in this market, banks will lend money secured directly against the physical chips.
Right. If Nebius defaults, the bank seize the hardware and resell it.
But to secure debt on that scale, to convince banks and bondholders to hand over billions, you need guaranteed ironclad income streams.
You need massive whales.
Exactly. Which brings us to the strategic partner forensics.
The foundation of Nebius's entire valuation rests on a contracted backlog of $46.4 billion. This is almost entirely driven by two mega deals.
Let's start with Microsoft.
Right. There is an agreement with Microsoft worth up to $19.4 billion. Nebius is executing on a massive, single-instance cluster to support Microsoft's Copilot and foundational model training.
And the second wheel.
The second is a newly announced, absolutely staggering $27 billion 5-year supply agreement with Meta. And this deal has a highly unusual nuance.
The backstop.
Yes.
Yeah.
It is split into two financial tranches. The first $12 billion is for dedicated, guaranteed compute capacity. Meta is just outright buying that space. But the remaining $15 billion operates as a backstop agreement.
Explain the mechanics of a backstop in this context. How does that protect Nebius?
It acts as an ultimate insurance policy. Nebius wants to build a multi-tenant cloud, meaning they want to sell space to thousands of different AI startups, not just one or two giants.
Okay, so they build huge clusters.
Right. And the backstop means Meta is legally committing to purchase any remaining unsold compute capacity across these new clusters, up to that $15 billion limit.
Wow. So if Nebius builds a massive data center and fails to attract enough startups to fill it, Meta automatically sweeps in and buys the excess at a pre-negotiated rate.
Exactly. Nebius gets guaranteed revenue to cover their debt, and Meta gets a guaranteed overflow valve for their insatiable compute needs.
So what does this all mean? Microsoft and Meta are basically bypassing their own supply chain and real estate bottlenecks by utilizing Nebius. It's like paying your neighbor a fortune to build a massive well in their yard because your own pipes are clogged.
Yes, because building a data center takes time and permits that can take half a decade to secure. But there's a third pillar to this strategy that explains Meta's eagerness: the NVIDIA alliance.
Right. NVIDIA recently made a strategic $2 billion direct equity investment into Nebius, giving the chipmaker an approximate 8.3% stake.
Which is huge.
$2 billion is a massive vote of confidence. But for a trillion-dollar behemoth like NVIDIA, that's almost a rounding error. What is the actual strategic mechanism behind taking an equity stake?
For Nebius, it is about securing a crucial early access moat. Because of this partnership, Nebius is confirmed to be one of the very first cloud providers globally to deploy NVIDIA's next-generation Vera Rubin NVL72 platform, starting in the second half of 2026.
And the technical filings make it clear that Vera Rubin isn't just a faster chip. It is a completely new rack-scale architecture engineered specifically to handle complex AI workloads and advanced reasoning.
And crucially, it demands native liquid cooling from day one. You simply cannot run it in an old air-cooled data center. Meta wants access to that Vera Rubin hardware desperately.
Desperate enough to sign a $27 billion agreement and provide a $15 billion backstop just to be first in line.
If we connect this to the bigger picture, you really have to look at NVIDIA's motivations here. NVIDIA is actively hedging its bets against its own biggest customers.
Meaning Amazon, Google, and Microsoft.
Right. NVIDIA does not want a future where the legacy Big Three successfully monopolize the AI infrastructure space, because that gives the Big Three leverage to dictate pricing.
Oh, so by funding and accelerating pure-play AI neoclouds like Nebius, NVIDIA is artificially subsidizing its own future market.
Exactly. They are ensuring there's a robust, diversified ecosystem of buyers for their hardware, preventing a dangerous oligopoly.
It is a masterclass in long-term supply chain manipulation by NVIDIA, but having a $46 billion safety net and the blessing of the chip kingmaker is one thing, actually executing on it is another.
The market definitely has some skepticism.
Right. Navigating a $20 billion physical deployment in a single year across multiple continents carries monumental risk. What is the bear case here?
Well, the bear case is deeply rooted in the unforgiving logistics of what they are attempting. First is pure execution risk. When your CapEx for a single year matches your entire market cap, there is absolutely zero room for deployment delays.
Right. If a massive data center construction project in France or New Jersey gets bogged down by local zoning laws.
Or if the local utilities delay their power procurement, the entire growth narrative fractures.
And the analyst reports also flag an extreme customer concentration risk.
Yes, post-2026, when these mega deals ramp up, Meta and Microsoft alone could represent a combined 70% of Nebius's total revenue. You have a beautiful backlog, but your eggs are sitting in two incredibly large baskets.
And there's also a geopolitical legacy hanging over them that the analysts mention. Nebius originally spun off from the Russian tech giant Yandex.
That's right. Now, Nebius has taken highly aggressive steps to scrub that legacy. They are headquartered in Amsterdam, listed on the Nasdaq, and have completely overhauled their board with Western executive leadership.
They also recently received approval to build a massive 1.2 gigawatt AI factory in Missouri. Building critical infrastructure directly on U.S. soil is about the strongest signal you can send to regulators.
It aligns them perfectly with U.S. domestic infrastructure goals. However, analysts note that residual regulatory friction could remain a lingering threat.
Wait, let's play devil's advocate on that customer concentration. If Meta pivots their AI strategy, say, Mark Zuckerberg decides to go all in on building custom Meta silicon in-house instead of using NVIDIA chips, does Nebius's $27 billion safety net just vanish overnight?
This raises an important question, and you've hit on what is arguably the ultimate long-term existential risk for any Neocloud.
Because we know Google has custom TPUs, Amazon has Trainium.
Right, and Meta is actively developing their own custom AI accelerators. If those homemade hyperscaler chips eventually outperform NVIDIA's hardware or become vastly more cost-effective to run, companies like Meta and Microsoft will pull back their external cloud spending aggressively.
So Nebius's only true defense against this is speed.
Precisely. They have to use this massive injection of capital to quickly build out their multi-tenant cloud, attracting thousands of smaller AI startups so that by 2030, they aren't solely dependent on the strategic whims of two tech giants.
It is a breathtaking race against the clock. Which brings us to the final verdict on the hyperscale challenger. After forensically examining the hypergrowth, the CapEx Mountain, and the massive NVIDIA alliances, where does the market actually stand on Nebius?
The consensus among institutional analysts rates Nebius as a high-conviction buy, but firmly tags it with a high-risk caveat.
They are uniquely positioned as the only truly vertically integrated alternative to the legacy Big Three.
Armed with a $36 billion visible backlog and that crucial early access to the newest Vera Rubin architecture, the upside potential is generational.
But realizing that potential requires flawless, relentless execution, it is a $20 billion tightrope walk.
I will leave you with this final thought to mull over. We've talked about how Nebius is building greenfield, liquid-cooled data centers because you can't retrofit the old ones.
Right.
If Nebius successfully proves that these purpose-built AI neoclouds are vastly more financially efficient, will the legacy giants, Amazon, Google, and Microsoft, be forced to eventually abandon their traditional infrastructure models entirely? Will they literally have to tear down the old cloud and start from scratch, permanently bifurcating the market between traditional compute and AI compute?
A massive question that will reshape the entire technology sector over the next 5 years. Risk defined, portfolio protected.